Hello and welcome back. Hope you had a nice weekend. Today the markets were closed due to Martin Luther King in the US, and so not much action around. However, I spotted a very interesting article that I wanted to talk about, and I wanted to mention GameStop because of this, because this potential new rule from SEC has to do a lot with GameStop and the event that happened, the short squeeze, the massive short squeeze that was originated from Reddit and Wall Street Bets, actually, which was the channel that kind of started the whole frenzy. And there is a proposition from SEC, and this is the Securities Commission basically in the US, and they're proposing the addition of extra cost for short selling stock in terms of some reporting, and this could potentially, they think, will deter short sellers and make it a little bit less difficult. They're more costly, a little bit more difficult and more costly to actually short sell shares of a company, thus potentially preventing new short selling events like the one that happened with GameStop, the bubble. And due to that news, I just wanted to, before we take a look at that, just quickly take a look at GameStop here, just to see what's going on with the company before we jump to the news, since we are at it. So GameStop, as you know, has been reaping last 1 year just because of this short squeeze event, and we want to know whether it's a potentially interesting hold for somebody, or maybe an interesting trade. So I have talked about it in a separate video. So now what I'm going to do here is I want to quickly just take a look at the cash flow of the company, and after that we're gonna jump to the news. I just want to take a look at what the company is doing financially, see if it makes any sense to enter the actual current market with GameStop. And interesting to notice that the company seems to be losing money in the last 12 months. Now it seems to be like on an average here with what they actually gained in 2021. So I guess it's you kind of have to decide yourself whether you like the situation. But I guess it's mostly in the positive, a little bit negative now. But the problem with what I'm seeing with GameStop is that it's a gaming company that has a lot to do. Not a gaming company, actually, a company that sells games. It's a retailer. It's a company that actually sells physical copies of games, and this goes down and down in terms of volume. People, I guess, like to buy digital copies. It's easier. You just have it at home without even having to go at the store. I mean, it's like super simple to download, so people prefer it. And even though physical copies can be cheaper in some situations, if not most situations. But other than that, a little bit of investing over here, and the sale of some property. I mean, nothing much here. And cash from financing, yeah, over here, what you would expect, they issued stock. I mean, you would expect that. Why did they issue stock? Because, the price is very high, and they got the opportunity to actually finance the company just by selling stock. And since we spotted that, we can actually take a look at the overview here, and just take a quick look at the outstanding shares. And actually they did go down overall, and the purchase happened here, so this is where they started going up, and this is when they made their money. I mean, it's a move that you would potentially expect, again, because the company's stock has been higher and higher because of the short sale, so they are taking advantage of the situation, if not advantage of the events, if not taking advantage of the investors, really. So yeah, you have to bear that in mind. They seem to be issuing some stock just because the price was up, and so the free cash flow is in the negative. That's something that I don't like to see. And let me take a look at the solvency here. A little bit less debt here. I guess they've actually financed some of the debt with the stock that they sold. So it's back to normal over here, I assume. Yeah. So maybe the company doesn't have that much of a risk for bankruptcy, at least yet. But in terms of what they're making, I'm not a big fan. I would take the company for a trade, but I wouldn't actually hold it for a long period of time. It's a fantastic trade over here. You may want to enter and trade a little bit. I don't know how it's gonna go. You have to take a look at the trend, and also take a look at some of the trading aspects of it, like the averages, the price, the volume. and potentially some indicators, key indicators, RSI, MCD, and all that. But in terms of actually holding for a long period of time, I wouldn't do it with GameStop. I'm a little bit too scared, and the company doesn't seem to be having great financials. Now, since we examined the company's stock, let's now take a look at the news, the piece of information that I wanted to share with you. And this is very, very important and very, very interesting, actually. Here it is. Here's the article. Hedge funds oppose SEC's reform plans after GameStop debacle. And regulators misguided securities lending proposals risk fueling volatility, say managers. And so you will see here that let me find the interesting parts here. Lenders and lending agents will together pay about $375 million in initial costs and $140 million annually thereafter to comply with the proposed reporting requirements according to SEC. So they are basically adding extra costs, making it more difficult for institutes to hold the stock short. So it's going to be tougher to potentially short a stock. Now, I'm pretty sure institutes, a lot of them would like to keep on shorting stuff, so they don't necessarily like this. They probably don't like this at all. And this is why there seems to be some controversy among some of the big hedge funds over here. And this is what the article discusses, really. And so I'm not sure myself that this is an interesting idea and this will actually help, rather than actually make it tougher for people to short, not because of the cost, because I'm sure that the institutes don't really mind the extra cost, but what they do mind is the fact that if things go wrong, they can actually lose even more money than projected. And this could work, but it kind of works in favor of the retail investor and not the institutes, and I'm pretty sure they don't like that. And this is why there is a lot of discussion over here. And you can see that several hedge funds managers said they saw a little upside in talking about their short positions in the current environment. They basically don't even want to talk about this, and because they are making big bets, and shorting can be a very, very lucrative thing over here. And so I'm not really sure that it would benefit the market overall. It may, but it's a very, very interesting thing. And you will see here that revenues from lending GameStop shares reached 121 million over the last 18 months, basically. And this bubble really made for a lot of borrowing costs over here, as you would expect. So that's it. This is a very interesting thing. I want to see how that plays out and if this will eventually happen. But you will also see here, that the demand from hedge funds pushed the cost of borrowing GameStop shares to more than 100% during the second quarter of 2020, an exceptionally high level, of course. So this is there was a lot of sorting with GameStop. Now the interesting thing right now is that if we go back and take a look at the general aspect here, the overview of GameStop, the actual short interest seems to be much down than what it was. So look at that here. Everybody's sorting. Everybody and their mother was actually sorting. It was actually more than 100%. The whole float was actually sorted and then some. And so this is why the massive short squeeze happened. But now it seems to be going down and down and down and down. So right now they're not even that sorted right now. So I wouldn't expect a short squeeze from here for sure, unless something radical happens. This 11% is high, but not that high. I mean, it's there are many companies that have this kind of level and nothing happens for years. So that's worth noting. If you are looking for a massive short squeeze, that's probably not going to happen again, at least anytime soon, really. So that's what I wanted to talk about. Bear that in mind. There may be some extra costs associated for sorting. I guess sorting in that level, like if you're sorting so much stock, I don't think it would affect the retail investor who wants to sort like 100 shares or so, but I think it will have a massive effect on sorting hundreds of thousands of shares. This looks like it's gonna be making a little bit of causing a little bit of trouble actually to some of the institutes that are sorting massively a lot of stocks. Alright, so that's what I wanted to talk about. Hope you enjoyed the video, and if you did like the video, you may want to take a look at this one where I'm talking about Bausch & Lomb, explaining a few things about what they're currently making in terms of their financials and examining their new IPO. Thanks for watching, and I'll see you soon. Bye bye.